All right, so I think I'm live, but just bear with me here. Yes. Damn, that just worked like that. Huh. Let me just check the sound. Da da da. Right. That sound. Excellent. Right. I can't believe that just worked like that. All right. Sure. Let me just hold on. Let me just switch off Slack. I get very distracted, you see, when I need all distractions gone. Hold on a second. All right, then. Well, thanks for joining me, guys. So, latest proposal. Hold on one second. Yeah, so there's been a couple of proposals lately. Let me just go over how they are. So basically, these ones concerning the liquidation. I think I thought I just. Right, sorry, I'm getting messages and I get distracted. Right, so the latest one is about the liquidation engine and the insurance fund. So basically, with the exchange, what we need to do is we need to have a system for liquidating positions and for guaranteeing that the exchange can always meet its liabilities if and when the high leverage traders get blown out in particularly volatile markets. So we have to have that system in place. The liquidation engine and insurance fund article that we posted today goes over how that's going to work. Basically, that's we're going to take your initial margin off you. When you go 50%, when you've lost 50% of that, if you take it to the point where the exchange has to take over your position, then basically the exchange stops you out as if you lost the full amount of the initial margin. And if the exchange gets a better price, then the exchange keeps that amount and puts it into the insurance fund. Now, that's the way it has to be. The exchange has to make money on these liquidation events because there will be times in the particularly volatile periods where when the exchange is forced to take over your position, the exchange will lose money. And that money has to come from the insurance fund. And so in normal conditions, the exchange has to be topping up that insurance fund. So basically, when you're liquidated by the exchange, you're suffering kind of like a penalty. And that penalty is placed into the insurance fund. That's pretty normal, pretty standard stuff. What these proposals talk about now is what we do with that insurance fund. So we have, at the moment, we have three options. So the first one, we can just leave the insurance fund alone and just let it build and build and build ad infinitum. That's one thing we can do. That's what BitMEX does. The second option that I proposed last week was the token burning option, where instead of just letting it sit there forever, as the insurance fund grows, we burn those tokens, and then if we ever need the insurance fund, we mint new tokens to cover the losses. So there's that idea. The idea behind that is that you're burning tokens and constricting supply, which is increasing the value of Digitex. And then the third option, which I proposed today, is where we start off with a big insurance fund of 100 million tokens, and then as it goes above that, as the liquidation engine makes profits, above that 100 million, then instead of burning those tokens, then we give those to the market makers to lose. So we're always keeping the insurance fund at 100 million tokens, which is more than enough, really. I mean, that's 10% of the supply. I mean, imagine a Bitcoin-based exchange that had 10% of all Bitcoins in its insurance fund. It's a huge insurance fund. So anything we go over 100 million, we would give to the market makers to lose on purpose, basically. And that's currently my favorite one, because what you're getting for your money there is, instead of just burning tokens or keeping them to constrict the supply, you're actually getting something tangible. You're getting something that improves the product. We're getting very liquid futures markets that will attract large numbers of traders who are coming in to try and win the tokens that those market makers are losing. So of those three options, my favorite is that one. I mean, let me explain the different the different possibilities of each one with an example. So let's take some assumptions. Let's say the Digitex Futures Exchange is going well. We've got a bunch of traders. Digitex tokens at say $1 a token, and the insurance fund is at 100 million tokens. And over the course of a year, the liquidation engine claws back, basically makes 100 million tokens. So let's go from that perspective, that example. So in the first two scenarios, where you either keep the insurance fund forever or you burn those tokens, the liquidation engine's making 100 million tokens. All right, so you've either locked away 100 million tokens from supply or you've burnt 100 million tokens. That's going to increase the price. That's going to increase the price in theory by 10%, right? Which is fine, but I'm not in this for 10% gains. I don't know about you. I'm in this for 10,000% gains. The third option is the liquidation engine's made 100 million tokens, and those 100 million tokens have been lost on purpose by the market makers. What we get in return for those 100 million tokens is extremely valuable, much more valuable than a 10% increase in the token price. You get highly liquid markets. You've given away $100 million worth of tokens to a group of traders. Now, how many traders do you think are going to be attracted to a futures market that not only has zero fees, but now has this mechanical edge built into the trader's favor by losing 100 million tokens to its collective group of traders? How many traders do you think are going to be attracted to a $100 million bounty? I mean, it's going to be a lot, right? I mean, 100,000 traders, 1 million traders, 10 million traders. I don't know how many it's going to be, but say 1 million traders are attracted to the exchange from that. What's the effect of 1 million traders coming in, all of whom have to buy Digitex tokens to compete for their share of those losses? What's the effect on the price of the Digitex token when 1 million new traders arrive? It's a lot more than 10% increase. And it just snowballs from there. We've got 1 million new traders. The price goes up from there. Next year, if the liquidation engine claws back 100 million tokens, which then get lost from market makers, the exchange is giving away $200, $300 million worth of tokens. That's going to attract huge numbers of traders. A lot of traders would be attracted to that. Some people say, well, you're making the tokens from the liquidation engine, which takes them from traders, and then you're losing them through the market makers, so you're actually not giving any tokens away at all. Well, that's not technically true, because there's two different sets of traders that are going to be on the exchange. Now, the liquidation engine basically penalizes high-risk, highly leveraged traders who, instead of stopping themselves out, actually force the exchange to take over their position by having their account run out of money. Now, they accept a penalty when they do that kind of action. There has to be a penalty because that's a risk vector for the exchange. Making the exchange forcibly take over your position because you've allowed your account to run out of money, that's a risk to the exchange. And the exchange has to, make money where it can on liquidation events like that, because there will be times where the exchange loses a lot of money on liquidation events like that. So there's a certain type of trader that is going to be exposed to the liquidation engine, and most traders that are willing to exercise just a little bit of discipline, they're not ever going to have to come into contact with the liquidation engine. It's perfectly possible to trade full-time all the time without the liquidation engine, without ever coming into contact with it. You just got to be well disciplined, stop yourself out. Liquidation engine doesn't affect you, and yet you can trade in a way that will target what the market makers are doing. You can trade as short-term, kind of like scalping style. You've got no fees to worry about, remember, and you can target the way the market makers are trading, knowing that those market makers are going to lose $100 million this year. Yes, there's a bunch of other traders trading with you to compete for those tokens, but that just creates more and more liquidity. So, the liquidation engine and the market makers, they're doing two separate things. The tokens are coming from over here, but they're being lost over there to a different style of trader. So that's just the explanation I want to give to you. I think it's a great idea. I think it will create very, very liquid markets. I think it's it's innovative, it's new, it's another reason why people would choose to trade on the Digitex Futures exchange and not another exchange. It is creating an actual mechanical edge in the trader's favor. You consider most exchanges with their with their trading fees and with the preferential treatment they give to third-party market makers, the odds are stacked against you. There's a mechanical edge working against you all the time. You've got to make money just to stand still. The Digitex Futures Exchange would be the exact opposite of that. There's no fees to worry about, and there's actually a mechanical edge working in your favor. The exchange is actually losing money to its traders, its collective group of this certain type of trader, the disciplined scalper type traders. The exchange is losing money to that group of traders, and you can easily become one of those groups, one of those traders that's in that group. I think it's a great idea. Right, so let me get to these questions. All right then. So these questions are also to do with the token burning proposal that I did last week. Now, as I say, I've kind of gone off the token burning one. I took a lot of suggestions and feedback from people. Some people liked it, some people didn't. I much prefer this, market maker losing tokens instead of us burning tokens. I think you get a lot more. The exchange gets a lot more bang for its buck by using those tokens to increase the quality of the product, i.e. the futures markets, than it does just by burning them. But these questions also address those the burning proposal too. So I'll go through these. All right, in the event of a liquidation cascade, how quickly can the insurance fund mint excess tokens? Well, that's one of the disadvantages of burning tokens. If you're burning them and then you need to mint them when the time comes, how could that be? And it wouldn't work trustlessly either when you think about it, because you'd have to kind of owe tokens and then go mint them. So that is a disadvantage of the token burning there, that the fund couldn't really mint tokens quickly enough to cover its losses. So that's a thing against the token burning system there. Question 2, why don't you use those tokens to cover exchange costs instead of burning them? When you do that, when you're kind of actually using the tokens to cover exchange costs, it kind of brings in kind of a conflict of interest, I think, when the exchange is actually trying to make money from its users to fund itself. I think it would have been much better to make the tokens, burn them, and then when the exchange needs money, it has to mint them for revenue generation. I think keeping those two things separate is a much better idea than the exchange trading against its users in order to generate revenue. That's not a good look at all. Next question: how do the DAO holders know how much an insurance fund minimum should be required? Well, that's another good question. How much how much should the insurance fund be? So that's why I think this market maker, combining the insurance fund with the market makers, is a better idea, because remember, the market makers have 100 million Digitex tokens, right? We set those aside in the ICO for the purpose of market making. So if we combine the insurance fund and the market maker fund, we automatically start with 100 million Digitex tokens, and we know that that's probably enough. It's 10% of the entire supply of Digitex tokens. Like I say, if you had a Bitcoin futures exchange with 10% of all Bitcoins in its insurance fund, you would say that insurance fund is big enough, right? So we don't know how much the insurance fund should be, but if we started at 100 million, I reckon we're good. So that's another advantage of combining the insurance fund with the market makers. Can the Digitex obtained through liquidations be used to promote the exchange by way of bonuses for people referring other users? That's an interesting concept. There was some people came out with that where they were saying, the liquidation engine makes the tokens. Instead of burning them, can you use those tokens really to fund affiliate program and refer a friend features and things like that? And that's one idea. I don't know. I would say, I think it's an idea. I think it's better to give the tokens to the market makers to lose in the markets, and to bid and offer and to create very liquid markets in the process, because you're getting something much more tangible. But that is one idea, that you could take some of those tokens to use to fund the affiliate program, and that is something that the DAO could vote on. When this becomes a proper DAO, we can vote on how many of the the liquidation engine profits get used for market maker losses, how many get used for, an affiliate program or a friend refer a friend feature, something like that. So it's a possibility. Isn't it the case that by taking Digitex out of the system with each liquidation, that the insurance fund causes a net reduction to supply anyway for the long term? Ergo, the supply is always decreasing, so why burn anything? Yeah, I mean, that was another good point, really. There's really not much difference in a practical sense of just letting the insurance fund build and build and build, as opposed to burning the tokens and then minting them when you needed it. There's really not that much of a difference, because the tokens that are in the insurance fund are effectively taken out of supply anyway. So that's really another thing against the token burning thing. It just seems so blah to just leave the tokens in there doing nothing, when with a little bit of innovation you can really use those tokens to only what's over 100 million. 100 million tokens is so many for the insurance fund. It just seems a shame not to be using those extra tokens for some, in some way to increase the quality of the product, like the market makers losing money would clearly do. Next question. The derivatives market is already unstable as it is. Insurance fund was invented by exchanges to minimize these risks when the price moves too fast and lots of traders get liquidated it. Destroying it just to pump the price by burning is not a good idea. Fair enough. I mean, that's one way of looking at it, and it's probably a responsible way of looking at it, and the market makers losing the tokens only over 100 million kind of addresses that. We keep the insurance fund at 100 million with the market maker proposal, and I think that is better than burning the insurance fund. I think it is. Instead of minting to support insurance fund, why not keep first X% in the insurance fund and another second X% in the treasury fund? First X%, the insurance fund grows, also taking tokens out of circulation, which will cause value of Digitex to increase. When it grows too big, we could vote on what to do with the token. Second X%, treasury fund will accumulate tokens. When the exchange needs operating cash, we could vote on how much to sell. That's another variation of the idea. Basically, this market makers losing tokens idea is basically the same as that, but instead of the treasury fund accumulating tokens, we're giving those tokens back to the market through loss-making market making. So it's a variation of that. Again, that's something that the Digitex DAO could vote on, whether we keep a portion of the tokens over 100 million for a treasury fund and then we lose the rest through market making or something like that. But yeah, that's an interesting idea too. Why not use market maker fund for backing up insurance for? Oh, that's an old question. Yeah, so someone's suggesting why don't we use the market makers fund for backing up the insurance fund? And that's the advantage of this loss-making market makers proposal, is that we do get to start off by combining the two, insurance fund and the market makers. We get to use the market makers 100 million tokens because we're still using them for market making. Will the dollar tick size be put back to $5 or even $10 with the current volatility? Yeah, probably the dollar tick size is a little redundant right now. So, I mean, it would work, but I think a $5 tick size, going back to a $5 tick size, would be much better, much more like a little more stable. The price won't constantly be flying off the top and the bottom of the ladder. It'd be easier to scalp, and it just differentiates us again. It makes the market a little bit different. Why not just use the insurance fund as an insurance fund rather than a cookie jar? Traders want to know they will be paid out when successful in a trade. Any system whereby referrals or market makers intentionally losing tokens is taken from the insurance fund basically means the exchange is incentivized to liquidate people to increase that fund. Well, I mean, I don't think the exchange is really, with the market makers losing the excess tokens, the tokens that are made from liquidation, I don't think, if the exchange is just giving those tokens away that it made, I don't think that's a very strong incentive for the exchange to, hunt down stops and to actively trade against its users. I can see the point there, but I don't think it is a strong incentive for the exchange to do that. And as I say, the advantages that come from using the excess tokens, over 100 million. I mean, as I've repeatedly said, over 100 million tokens We're doing something with that increases the quality of the product. 100 million tokens is a lot of tokens. It's a huge insurance fund. So I think it's okay. I don't think, giving tokens away that the liquidation engine has made, I don't think that's a strong incentive for the exchange to start being shady and to just start actively trading against its users and stopping them out. Coinbase experienced a brief outage Wednesday afternoon with both its website and API rendered temporarily inaccessible as the price of Bitcoin dropped more than $1,700 in the span of 15 minutes. How is Digitex going to avoid outage issues like Coinbase's from occurring? The only way I can answer that is just to get the best developers that you can get, right? And we've finally done that. It took us a few attempts. I'm the first to admit we made some mistakes with the development process, but what doesn't kill you makes you stronger, right? And we're at the point now where we're in a very, very strong position right now. So all I can say is that you just hire the best people you can, which we have now done, and you've got to leave questions like that to them. Obviously, we're going to have as much redundancy with the servers as possible. Follow all the best practices that you can, and I've just got to leave it in the hands of some very qualified people. How will Digitex create revenue other than mint tokens? Well, this is the thing. Minting tokens is our stated revenue generation method, as in the white paper. But until June 2021, we have the Digitex Treasury, which currently has something like 91 million tokens in it already. Now, if the Digitex token went to $1, that's $90 million that we've got there. That's going to last us a while. That's going to put off the need to issue tokens until probably after June 2021, right? If it goes up more than that, we've got even more money. On top of that, we've got, IEOs. When we come out with the spot market, with something like this market make IEOs and make a fortune. If you've got millions of users, IEOs are going to make us a fortune. People, tokens are going to pay us high listing fees to get on our spot market. There's all kinds of other ways of generating revenue from a large active crowd of millions of traders other than charging trading commissions. So people think that it's, we don't kind of money you can make from a large crowd of active traders. There's all kinds of other revenue generation possibilities other than token minting. Token minting could feasibly be years and years away before we even have to do that. If we ever even had to do it, there's that side of it. Does the team intend on publishing the entire code base of the exchange or certain elements that are not proprietary? Like the scaling stuff, the Ethereum scaling stuff that that we're going to be doing, the non-custodial side of things, we actually are going to be making that. We're going to be putting that on GitHub, and we're going to be putting that kind of like open source. I don't know if we'll be doing absolutely 100% of it. We might be keeping a couple of things back that are proprietary, but we are going to be putting out there as much open source code as possible. One, just to give back. Two, smartdec is such a they're really on the sharp end of what's going on here. We've got we've got a very smart bunch of guys in full-time research right now on how to scale Ethereum quickly enough to be able to have a non-custodial exchange that can do real-time trading. And it would be a shame to keep all that to ourselves. We're standing on the shoulders of giants really when with all the technology that we're currently using, and by giving back, it's we get back more than we give out if we do it that way. The Ethereum community is very strong. If we do our part and we publish the code and the research and the developments that we the stuff that we discover and the stuff that we research, if we put it out there, we'll get it back tenfold. So it's a business decision as well. It's not just a happy clappy come buy our stuff. It's it helps us out. If I verified with the Treasury and thereby deposited also my own wallet addresses, this can serve as proof of my held to. Yeah, yeah. If you've already KYC'd with the Digitex Treasury, then oh wait, if I verify, you mean do you get your DigiDAO tokens if you don't have those Digitex tokens deposited with us? Um, your Digitex tokens will have to be deposited somehow with us. I mean, we are going to have a trustless option where lock them up in some kind of state channel or something where you get to hold your private keys, but you are going to have to lock them up or deposit them with the exchange somehow in order to receive your share of DigiDAO tokens. Yes. What are the plans for Digitex token integration to decentralized exchanges? The problem with those exchanges is we started off as the Digitex token is an ERC 223 token. It's like the same as an ERC 20 token, but it's slightly different. And these decentralized exchanges don't support them. So ERC 223 was a more advanced type of ERC 20 that had a couple of extra benefits regarding gas savings on decentralized exchanges. But none of the decentralized exchanges implemented it. So, we tried being a little advanced there, and because of that reason, we couldn't get listed on decentralized exchanges. Is Digitex going to implement copy trading? I mean, it's an interesting thought. It's not something that's going to go into version 1, but yeah, I mean, why not? I mean, I think copy trading is an interesting concept, but it's not something that I've given a lot of thought to at the moment, to be honest with you. But I'm not saying no. Will Digitex holders that have already gone through KYC from Treasury be allowed to receive DigiDAO without any additional KYC? Yeah, I mean, if you've already done KYC, then you don't have to redo it. I mean, I hate KYC to start with anyway. It's a complete waste of time, but I'm not supposed to say things like that. But yeah, if you've done your KYC already, then we won't make you redo it. Hi, Adam. Excited with the Digitex exchange getting close to fruition. I would like to know what the proportion in which Digitex DAO will be given for holding Digitex tokens. That's not a fixed thing. So the number of DigiDAO tokens that get released to the community is a fixed thing. On a daily basis, there is going to be something like, it's 800 million tokens over the course of 5 years on a daily basis. So it works out something like 450 something thousand DigiDAO tokens per day will get distributed to the Digitex tokens that are held in the exchange, either trustlessly or not trustlessly. So it depends how many Digitex tokens are held in the exchange, right? So, if there was only 100 tokens deposited into the exchange on October the 1st, then those 100 tokens will receive all 450,000 DigiDAO tokens. If you take it to the other extreme, if there's 500 million Digitex tokens in the exchange on October the 1st, then those 450 something thousand DigiDAO tokens will get distributed equally amongst those 500 million Digitex tokens. So it's completely dependent on how many Digitex tokens get deposited into the exchange. And by doing it that way, it's gonna keep the prices of the two much more aligned, I think, because as the price gets out of line, if the value of the DigiDAO token is rising, but there's only a few Digitex tokens in the exchange, then those Digitex tokens are going to be getting a hell of a return on their money, really, right? So people are going to put more Digitex tokens into the exchange, which is going to dilute the return that they're getting from being held in the exchange. And just on the subject of securities and things, that doesn't make the Digitex token a security because it's receiving DigiDAO tokens. It's only Digitex tokens that are deposited into the exchange that are receiving these free tokens. So the Digitex token intrinsically itself does not get a dividend. Right, what if in scenario where market maker loses too much fund than what was gotten from insurance fund? On this next question, what if the insurance fund can't keep up with the losses of the market makers? those two questions are the same. Well, they're going to be. I mean, we can tweak the parameters. The operational parameters of the market makers can be tweaked very easily. We can very easily control the rate at which the market makers lose money by adjusting the size that they trade, adjusting how tight the bid and offer spread is, how aggressively they follow the price. There's just a bunch of things that we can easily adjust with the market makers that we can easily adjust how much money they are going to lose. But making them lose money is going to be so much more effective for the purpose of market making. If you need to even just break even as a market maker, or even trying to make a profit, the liquidity you're providing is way less than if you can just bid and offer willy-nilly and just go crazy with the bids and offers, and over a period, over time, it's gradually just going to lose a tick here, lose a tick there, break even, lose a tick. You're going to have little profits too, but just by that frenetic pace of trading, it's easy. Put it this way: it's easy to lose money. It's hard to make money. So if you're willing to take small losses with these market makers, you can do a lot of trades, a lot of bidding and offering, and you can keep that bid offer spread tight, even in volatile market conditions, which if third party market makers, for instance, won't do because they're always trying to make a profit. I'm curious as to what's driving these recent changes. I mean, you just got to stay, development's taking a little longer than we had hoped. We got to stay relevant in the meantime. You got to stay innovative, right? I mean, I don't know if you saw, I think it was last week, Bitcoin.com did an article where they were basically saying, there's a lot of exchanges, they've got to be innovative now to stay relevant. And of the, I think, 4 or 5 exchanges they used as examples in that article, one of them was Binance, one of them was Digitex. They used us as an example of, an innovative model that is slightly different from other exchanges that has the potential to be, to do big things. And really, that's what all these little changes are. I mean, they're not really changes. I mean, I've wanted to do a few of these things for a while. These things do need addressing, like, for instance, how we liquidate losing positions, what we do with the insurance fund. We did have to address this. We didn't address that specifically in the white paper, so it does need doing. And now that I've got smartdec, now I've got the best team I could possibly ever hope to have. I've moved to Moscow to be with these guys. These guys are just next level. Now I've got these guys, and I can do pretty much what I want to do. That's what's driving these recent changes. I've now got the ability to implement, the ability to execute that I didn't have before. So I now have the ability to turn ideas into action in a way that I didn't have before. So that's what's driving these recent changes. Will there be a Digitex mobile app? Well, yeah, I mean, at some point, not in version 1. The mobile app is not something that I've got on the list right now. But yes, there will be a mobile app, yeah. All right, those I think I've covered those questions. Yeah, so just to wrap up, like I just said, I'm in Moscow right now, working with smartdec. There's such a talented team, and we've got like 13 people now from smartdec working on this. This is happening in a big way. I mean, out of those 13 people, I think 5 of them are like PhDs. These just aren't 13 normal people. Well, actually, I know 3 of them have actually got PhDs. I think one's doing a PhD in economics, and the other one is a PhD dropout, a physics PhD dropout. But I mean, a physics, just the fact you were even doing a physics PhD is enough for me. I don't care if you dropped out or not. But my point is, there's 13 people working on this right now. The implementation that we have now, the ability to execute on this, we've never had this before. Yes, we had some issues with development. Yes, there's been delays, but we're in a very, very strong place now. We are running full steam ahead. We've got the funds we need to do it. Everything's here. Like I say, I've moved to Moscow. I'm working with these guys full time. I'm actually going to be in Barcelona though next week. I'm doing some kind of like trading workshop at there's a big trading conference in Barcelona, so I'm going to be there. And the tickets are actually free, so if you want to pop by Barcelona, I'll be there. Come say hello. There's going to be more proposals coming, I'm sure. You know, now that like I say, I've got the ability to execute on ideas. I'm going to be putting ideas forwards as if we were already a DAO. I know that we're not a DAO yet, but you know, kind of get in the spirit of things. We're going to be a DAO soon, so I think it's quite good that, you know, when I have an idea, I don't just say, hey, this is what we're going to do. You know, I can just propose it to the community. You know, people can say that's a great idea or that sucks, or you know, and we can discuss it from there. All right, well, that looks like the end of the questions I've got on my sheet there. All right, keep your keep your feedback coming. Please just let us know what you think about everything we're doing in Telegram, everywhere. Just, you know, don't hold back. Let us know if you think we're doing a good job. Let us know if you don't think we're doing a good job. All right, I'll speak to you soon. All right, cheers, guys. Thanks a lot.